Boom! What's going on, Investomaniacs? Your boy Knight Rider here, and today we're going to be talking about Revolve because Ronald asks, Investomania, what do you think about Revolve? Well, listen, brother, I think you've got some sense. I like Revolve. I liked it before. It was just pretty darn expensive, but now we got a nice discount on it. So let's go ahead, let's go through it, talk about the numbers and that nice discount that we're getting over these past couple months. So Revolve Group, what is it? An online clothing and accessory retailer. They operate through 3 sites. Revolve, that's their big site where the large majority of their sales come from. And then Forward, that's a very high-end site, which is a smaller portion of their sales. And then their new site, Super Down, that they're currently building up, and that is the cheapest of the 3. I wouldn't call it a cheap site or low end. It is just cheaper than Forward or Revolve. Let's take a look. This is Revolve. Again, that's their primary site. This is their Instagram following. 3.4 million followers. Dang. Forward, this is their very high-end site. Take a look at some of these prices, man. We got $1,000, $1,800, $260 for that little skirt, $260. Got some Fendi, yeah, $420, $180 for this t-shirt. I don't get it, man. This is beyond me. But they have 455,000 followers. And then we've got Super Down. That is their lesser expensive, newer site. And they have 113,000 followers there. So very strong social media following, which makes sense because they are an online clothing retailer. This is a disruptor. What is the brick and mortar retailer's pain?
The House of Pain.
Is the online clothing retailer's gain.
House of Pleasure.
Because people still got to buy clothes. They're just changing how they buy clothes. And it makes sense that we're going to have a couple new companies come in and establish dominance in this new online clothing area. So I like it. Now, this is here are some of their strategic advantages over brick and mortar. First of all, they have much quicker testing, rollouts, and turnover of new styles and trends. If something's not working out, they can get rid of it almost instantaneously. They can very quickly test things out. And because they don't have any physical locations, they don't have to hold a lot of inventory. That means they don't need to put as many things on sales. They can keep their margins higher and they have less stuff sitting around losing money. So I like that. Also, they have a whole lot of private label, and we always know that private label means better margins. Doesn't really matter what we're talking about. Private label is a good thing. What are some of the problems? The trade war. Roughly 40% of their merchandise is sourced from China. So that means if the trade war intensifies and tariffs go up, that's bad for this company and anything, of course, that's getting a lot of their merchandise or sourcing from China. So that is something I'm concerned about, and that's one of the reasons I didn't like it so much at the higher prices. But now that prices have come down so much, we're talking in terms of the stock has basically crashed. It's down like 50% off its highs. Due to that, I think that it's okay that we're getting a large amount of stuff sourced from China. And even if we see some increased costs associated with that, we're getting enough of a discount on the stock to where I like it now. Let's take a look at this stock. It peaked at $48.36. We are now down basically exactly 50% to $24.16. Dang, take a look at this. So we just IPO'd over here on kind of early June, popped up real quick up to, a little past $48, and then we just had this big old crash. Because prices were a little bit elevated, it was an imperfect quarter, so we did see a pretty big drop here. It wasn't a bad quarter by any stretch of the imagination. It's just that when you have elevated prices, you need to have exceptional quarters, and if there's any little hairs of problems, you're going to have a big sell-off. That's what happened. It wasn't a bad quarter. The price of the stock was just too high. This is a more fair valuation that we're seeing right now. Let's take a look at some of the numbers. We'll go through this most recent quarter. So net sales of $161.9 million, a year-over-year increase for the quarter of 22.8%. Beautiful. Try and find that in retail elsewhere. Gross margins of 55.8%, a year-over-year increase of 21 basis points. By the way, this top line is actually increasing from the previous quarter, as well as our gross margin is increasing in its basis points. So that's a fantastic thing. thing. We're seeing acceleration of revenue growth and improvement of gross margin. Also, 1.359 million active customers, a year-over-year increase of 36.2%. I love that. That's really strong customer growth. And I think down the line, that will result in stronger top line growth. And almost 1.3 million orders placed, a year-over-year increase of 30.8%. Again, very strong growth there. We have our market cap of $1.664 billion. So let's take a look at, again, a couple of these numbers. Market cap here, our trailing 12-month revenue is about $553 million, which means that we're trading about 3 times revenues. Not too bad for a company trading or kind of growing at these rates. We have that 22.8% year-over-year growth, accelerating revenue growth over the last quarter. Our net income is at $33 million, which is about 50 times earnings. And again, for a company growing at the speed it's growing, I like that price now. And mind you, we could be making more money. So in reality, this isn't as expensive as it looks because we're reinvesting quite heavily to build SuperDown, their new third site that they're going to be selling on. So I'm okay to take a little bit less in earnings if that means we're reinvesting it back into a new product. So the conclusion, I think it's a fair valuation. I like the space. I like the online clothing retailers. I do believe that is going to be increasing in the future. And I say it's a buy. Buy. You guys have a good day.